Large RRSP can be a ticking tax bomb for some Canadian. In this video, I'm going to explain how large RRSP has a huge tax bill, and I'll explain some of the strategy that you can take to fight against our beloved CRA. Hi, this is Ahmed Mahiyan from Fire Financial, and in this channel, I share my finance knowledge so that you can take smarter financial decisions. I was an investment consultant at one of the largest 5 banks in Canada around 2 years ago. And at that time, I was lucky to help a client who was transferring almost $700,000 to $800,000 from her RRSP and Lira account to that big bank. During that process, I was helping with 2 other advisors who are helping her to make retirement planning and basic investment recommendation. She was around 76 when she first met us, and I'm talking about the end of 2021 when the stock market was really hot. Now, she was actually an employee of the same bank and she worked there for 40 years. We initially had a discovery meeting where we went over some of the basic questions about what's their goal, what are the income sources, things like that, that most financial planner or financial advisors do as a discovery meeting. She had the initial meeting and then we didn't hear from her for the next 3-4 months. And we were kind of worried about it because, as a banker, you don't get any commission if you don't close the sale. So obviously the managers were looking for where the money is. So we had to contact the client for 3-4 times, but we didn't get lucky to connect with her. So after 4-5 months, she calls us back and she let us know that her husband passed away during that time. She was kind of hopeless because she was planning for this retirement, but now that her husband passed away, it's kind of something that she never planned. The advisors at that time recommended her to, take the money, the minimum amount of money that she needs to support her lifestyle from the RRSP and let it grow. During that time, I recommended something different. I saw the red flag because she has around $800,000 RSP and she was recently widowed. So my thought is if she passes away soon, this whole $800,000 RSP will be fully taxable in the year she passed away. Because she doesn't have any spouse, she cannot roll over that RSP to the spouse. That was the thing that I explained to my other 2 advisors and suggested that we aggressively melt down the RSP to avoid any significant tax bill. Now, the problem is the way the banking industry works is if they have asset under management, that pays bigger trailing amount to the bankers. So they ignored my recommendation and just let her invest in the RSP and doing nothing to melt down the RSP. So in this video, I'm going to go over a tax calculator where I show you why it is a huge risk for that client and how you can avoid such a large tax bill. Now, if you don't know what RRSP is and how RRSP tax deduction works, this is a quick recap. So I'm using Ernst & Young tax calculator, and I'm assuming that your income is $100,000. So at $100,000 income, I live in Ontario, so your average tax rate will be 22%. Now, if I go to a tax savings calculator from the same website, and my income is again $100,000, and I'm contributing a $20,000 to my RSP, that will generate a $6,600 refund when I file my taxes at the end of the year. Now, the idea of an RSP is you contribute when your tax rate is higher, meaning that most people, when they are working in their 30s, 40s, 50s, their income is much higher than what they will be earning in their retirement. So assuming that your taxable income is lower in your retirement, let's say your income is down to $70,000, at that rate, your tax rate is 18%. So you are reducing your income tax rate from 22% to 18%. That 4% difference that you can see here is the benefit of contributing to RRSP. Plus, you have the tax deferred growth for the last 30, 40, 50 years during the time your money grew within the RRSP account. So that's the basic benefit of an RRSP. Now, for some Canadians who were diligent to put money away in their RRSP and managed to grow it into a large RRSP because they had market growth, they diligently contributed over the years. So they probably have maybe $1 million, $2 million RSP, and that's the ticking tax bomb that we are talking about here. To understand that concept, I'm using a TurboTax calculator here to give you the example. When you are retired or you have a large RSP, you have two options. So either you can take out money from your RSP directly, and that way you will be paying a withholding tax, meaning that if you withdraw less than $5,000, there will be a 10% withholding tax from your financial institution. And if you withdraw anywhere from 5,000 to 15,000, there is a 20% withholding tax, and anything over $15,000 will generate a 30% withholding tax. So this is actually not the amount of tax you pay to the CRA. This is just a withholding amount that your financial institution withhold from your payment and remit to CRA. So at the end of the year, when you file your taxes, that's the time when they will recalculate your tax payment and see if you have paid them more than what you should paid, and that's when the adjustment happens. So if you have paid more through your withholding tax, you will receive a refund when you file your taxes, and vice versa. Now, depending on the withdrawal type, you probably will end up with one of these two. Either you will receive a T4 RRSP slip or a T4 RIF slip. So if you withdraw directly from your RRSP, your financial institution will fill out this form and send it to CRA. And when you file your taxes, you are going to give this slip to your accountant and they will do all the calculation for you. If you are withdrawing money from your RIF account, then it's the same information that will be included in this slip. Now, in my case, when I was helping that client, first of all, the client just recently lost her husband, so she is basically a widow. So there is no way she can roll over the RRSP. So what rollover mean is if somebody pass away with an RRSP, normally they can roll it over to their spouse. This can be a marital spouse or a common law partner. They can roll over that RRSP to a spouse without triggering any tax. For example, if somebody has a $300,000 RRSP and the husband passed away, the $300,000 RRSP can just roll over to wife's RRSP without triggering any tax. The tax liability triggers when the second spouse passes away. That's when CRA hunts down and asks for their money. So this is why I recommended an aggressive withdrawal strategy for that particular client. Imagine that she had an $800,000 RSP, and when she passed away, that $800,000 will be included as in other income, and that will generate a huge tax liability for her estate. So as you can see here, so $800,000 will trigger a tax, and she will be paying around $240,000 to the federal tax, $150,000 to the provincial tax. So her total combined tax liability will be some amount close to $390,000. She will only be able to pass $410,000 money to her beneficiaries. In this case, she has a adult son where he will receive the proceed from the RSP if she passed away. So that was the main argument that I had with my other two advisors, that we need to encourage the client to spend more because she has a sizable RSP, and no matter how much she withdraws, it is very difficult for her to spend all the money because she has been living very frugally for the last 40 years, and this is very unlikely that she is going to spend all of her money in the next 20 years. So even if we estimate that she is going to live 95 to 100 years of age, including with her CPP, old age security, and this pension, she will have hard time spending this much money. That's the tax bomb for her if she were to pass away soon. Now, if you look at this average tax rate, you will see that indeed, if she passes away right now, the average tax rate will be much higher compared to what she has estimated when she contributed to those RRSP. And her marginal tax rate will be 53%. So I'm using Ontario as an example. As you can see, these are the tax brackets. If you want to know more about tax bracket, check out the video that I listed in the description, where you can understand how the tax bill is calculated using different tax bracket. Whether to melt down your RRSP faster depends on a number of factors. The first and foremost, you have to see if you are a single or divorced or a widow. If you do not have any surviving spouse or common law partner, you need to think about seriously to melt down your RRSP, because as soon as you pass away, the whole amount becomes a taxable income to your estate. So this is a huge tax liability for your executor, because they have to come up with a huge tax bills to pay, and most likely your RRSP will be half gone to CRA, especially if you have a large RRSP. If you have a smaller RRSP, it might not be a big deal, but again, do the plan ahead of time. Second, if you have shorter life expectancy, it becomes a discussion whether to withdraw the money early to avoid those tax trigger. We have to look at the full picture if you are married or if you are a single person. So these factors also goes into that decision making. Number three, if you are planning to get money from your CPP and old age security and you are planning to delay those payments, it is a good idea to start withdrawing money from your RRSP ahead of time. Because if you delay your RRSP withdrawal, it might be too big, and when you convert that to a RIF, it might have a bigger RIF payment that may trigger an OAS clawback, where you do not get any OAS money from the government. So OAS stands for Old Age Security, which is available for Canadians who have been living in Canada for a long time. So if you want to know more about the Old Age Security program, check out my other video where I go details about the Old Age Security. Nevertheless, if you are planning to delay your CPP and old age security, make sure to draw down your RRSP so that you don't have too much income in your later years where you may have to give back some of the old age security amount. So work with your financial planner. They will give you what will be an ideal amount to withdraw from your RRSP while making sure that you have enough money for the rest of your retirement life. Number four is the years you don't have too much income. That's the best years to withdraw money from your RRSP. As we have seen in the calculator, the year you have lower income, it makes sense to withdraw money from your RRSP during those years because your tax bills will be much lower. And a lot of time, what we recommend is withdraw the money and put it into the TFSA account. So tax-free savings account, also known for TFSA, is a type of account where you grow your money completely tax-free. That's the beauty of that account, that if you withdraw the money from your RRSP while you're at a low income tax bracket, you contribute that money to your TFSA and grow tax-free. So this is a great strategy where you can maximize your overall tax bill. The number five, no matter what reason you choose to withdraw your money from your RRSP, make sure you have a solid retirement and estate planning. A retirement planning will include all this information in a plan where they project your estimated CPP and old age security amount from the government, your taxable amount from all those RRSP and RIF withdrawal, and your expected expenses during those years. A retirement plan will also include some of the estate planning topics such as beneficiary, and how you are going to prepare for your estate tax bill. So this is a huge topic for wealthy Canadians who have large RSP. Maybe they have a business, or maybe they have large investment account. Finally, if you like this video, please check out my other videos on the channel